In 2025, the Federal Reserve cut rates 3 times, making headlines and stirring up conversations across the country. Many hoped these moves would breathe new life into the sluggish housing market, just as they had in the past. Lower rates typically mean cheaper mortgages, and that's often enough to get buyers off the fence and sellers eager to list. The cuts sparked hope for a housing market revival. Buyers imagined finally being able to afford their dream homes, and sellers anticipated a rush of offers. Real estate agents prepared for a busy season, expecting a surge in open houses and bidding wars. Yet, despite all the optimism, the market remains stubbornly stagnant. Activity hasn't picked up, and both buyers and sellers are still on the sidelines. The energy that usually follows a rate cut just didn't materialize this time. The expected boost from lower rates never arrived. Listings sat untouched, and homes lingered on the market for weeks, sometimes months, with little interest. Why? Because the real issues run deeper than borrowing costs. Open houses are quiet, bidding wars are rare, and the excitement that once defined the market has faded. Even with lower rates, many families find themselves priced out or unable to compete. Affordability is still out of reach for many. Home prices remain high and wages haven't kept up. For some, even a small drop in rates doesn't make a difference when the down payment and monthly payments are still daunting. Sellers hesitate to list, creating a persistent shortage of homes. Many homeowners are locked into ultra-low mortgage rates from previous years and see little incentive to move, knowing they'd face higher costs elsewhere. This feedback loop, low activity causing even lower activity, has left the market stuck. With few new listings, buyers have little to choose from, and the cycle of inactivity continues. The focus is shifting from the Fed's actions to the market's underlying structure. Experts are now asking tougher questions about what's really holding the market back. It's not just about rates, it's about too few homes, locked-in homeowners, and a system that hasn't adapted to today's realities. The market is grappling with a shortage of inventory and a mismatch between what buyers want and what's available. The legacy of past trends, years of underbuilding, rapid price growth, and changing demographics, continues to shape today's challenges. The market is still feeling the aftershocks of previous booms and busts. To understand why rate cuts failed, we must look beyond headlines and examine the market's deep-rooted problems. It's a complex puzzle, with affordability, supply, and consumer confidence all playing a role. The Fed's tools alone can't fix what's broken. Monetary policy can only do so much when the real barriers are structural and long-standing. Real change requires addressing the structural issues built up over years, like building more homes, rethinking zoning laws, and finding new ways to make housing affordable for everyone. Only then can the market truly move forward. At his December 2025 press conference, Federal Reserve Chair Jerome Powell delivered a message that cut through the noise. More interest rate cuts alone won't fix America's housing crisis. His words landed with a weight that was hard to ignore, signaling a shift in how the nation must think about the housing market's challenges.
Powell openly admitted that the Fed's primary tools, mainly adjusting interest rates, are simply not enough to address the deep underlying issues plaguing the housing market. Lowering rates might make mortgages a bit more affordable, but it doesn't magically create more homes or resolve the supply crunch.
The Federal Reserve's mandate is to manage inflation and support employment, not to directly control how many homes are built or how quickly new housing comes to market. That's a crucial distinction, and Powell made it clear that the Fed's influence over housing is limited.
Even if mortgage rates drop further, it won't solve the fundamental mismatch between the number of people looking to buy and the limited number of homes available. Families are still left competing for too few properties, driving prices up and leaving many out of reach. Powell's honesty forced a national reality check. It was a rare moment of candor from a central banker, and it made clear that the solution won't come from monetary policy alone.
The real issues are structural and long-term, things like zoning laws, construction bottlenecks, and demographic shifts. These are challenges that stretch far beyond the reach of the Federal Reserve's levers.
The Fed now projects only one more rate cut in 2026. For those hoping for quick relief from Washington, Powell's message was clear. Don't expect the central bank to ride to the rescue.
Powell's message was a call to action for policymakers, local governments, builders, and the private sector. Real progress will require coordinated efforts to increase supply, reform regulations, and invest in new housing solutions. The era of waiting for the Fed to save the day is over. The responsibility now shifts to those who can address the root causes of the crisis. To To truly fix housing, the focus must shift to the root causes: building more homes, modernizing policies, and creating opportunities for all Americans to find a place to call home. The heart of the problem is a chronic housing shortage, a crisis that's been quietly building for years, shaping the lives of millions of Americans. It's not just a recent issue, but one that's been decades in the making, affecting families, young professionals, and entire communities. For over a decade, the U.S. hasn't built enough homes to keep up with demand. Every year, the gap between the number of homes needed and the number actually built has grown wider, leaving more people searching for fewer options.
After the 2008 crisis, construction never fully recovered, leaving a huge gap. Builders pulled back, projects stalled, and many skilled workers left the industry. The effects of that slowdown are still being felt today, as the pace of new construction remains far below what's needed. Millennials and Gen Z now face fierce competition for too few homes. Many are forced to rent longer, move in with family, or settle for less than they hoped for. The dream of homeownership feels out of reach for an entire generation.
This scarcity drives prices up, making homeownership unattainable for many. Even those who can afford to buy often face bidding wars and skyrocketing costs, putting enormous pressure on families and first-time buyers.
Lower rates can't create new homes. They just fuel demand for what little exists. When borrowing is cheaper, more people try to buy. But with so few homes available, it only makes the competition more intense. In fact, lower rates can worsen the problem by pushing prices even higher. The result? More frustration, more disappointment, and even greater inequality in who gets to own a home.
The only real fix is to build more homes: single-family, townhomes, condos. We need a surge in construction to meet the needs of today's buyers and renters, and to give future generations a fair shot at homeownership.
That means changing zoning laws, investing in infrastructure, and lowering construction costs. Local governments, developers, and communities all have a role to play in making housing more accessible and affordable. These are tough, long-term challenges. Solutions won't happen overnight, but without action, the shortage will only get worse. Until we build more, the market will stay stuck, no matter what the Fed does. The path forward is clear: more homes, more opportunity, and a renewed commitment to solving America's housing crisis.
Another obstacle is the golden handcuffs effect. During the pandemic, millions locked in ultra-low mortgage rates.
Now with rates much higher, moving would double their payments, so they stay put.
This traps homeowners, reducing the number of homes for sale.
The market depends on people moving up, downsizing, or relocating, but most are staying put.
This lock-in effect keeps inventory low and prices high, despite lower demand.
Rate cuts in 2025 didn't help. Homeowners won't move unless rates return to pandemic lows, which is unlikely.
Buyers wait for more listings, sellers wait for lower rates, a stalemate. The result? A frozen market. The golden handcuffs are a powerful force the Fed can't break. Real solutions require more than just lower rates. The housing market is caught in a vicious cycle. High prices and low inventory feed each other. Even as demand cools, prices stay high because there's so little to buy. Low supply props up prices, keeping homes unaffordable for most.
Rate cuts barely move the needle. A small drop in payments doesn't make expensive homes affordable. First-time buyers face the toughest odds, with little inventory and fierce competition.
Many give up, waiting for better conditions that never come. Sellers too hesitate. High prices and high rates make moving unattractive. The cycle continues. Few listings, high prices, frustrated buyers and sellers.
Minor rate cuts can't fix this. The affordability crisis is too severe for small changes to matter. The dream of home ownership slips further away.
A clear sign of trouble: more homes are being delisted, taken off the market unsold.
In 2025, the listings surged, up 45% from the previous year. Sellers hoped for high prices, but found few willing buyers.
Many give up waiting for better times.
Since June, about 6% of listings are removed each month, the highest rate since tracking began.
High delistings show a gap between seller expectations and buyer reality. Each delisted home tightens supply, worsening the cycle.
Sellers are voting with their feet. This market isn't working for them. Many will wait for lower rates or more buyers, but relief may be far off.
As long as affordability is a problem, homes will stay off the market. The delisting trend keeps the market frozen. Delisting is a last resort for sellers. After investing time and money, they walk away unsold.
Many hope to match the high prices of past years, but today's buyers can't afford them.
Mortgage rates are double what they were at the market's peak, shrinking buyers' budgets.
Most sellers are also buyers. Selling means facing the same tough market and high rates. For many, it's not worth it, especially if they lose a low-rate mortgage.
The logical choice is to stay put, leading to more delistings. This collective retreat keeps the market frozen.
Until conditions change, sellers will keep waiting.
The market is shaped by millions of personal decisions, not just numbers. Rate cuts can't change this behavior. The freeze continues. The housing market struggles reveal the limits of monetary policy. The Fed can make borrowing cheaper, but it can't build homes or change local laws.
Rate cuts don't create supply or convince locked-in homeowners to sell.
The real issues are physical, too few homes, and behavioral homeowners staying put.
Trying to fix a supply shortage with rate cuts is like fixing a leaky pipe by turning up the radio.
Powell's candor made it clear. The Fed can't solve this alone. The solution lies with cities, states, and builders. Reforming zoning, streamlining permits, and investing in construction are key.
The Fed can support stability, but others must do the heavy lifting.
The focus must shift from monetary policy to real-world action. Only then can the market recover. If rate cuts aren't the answer, what is? The solution is clear: build more homes.
More housing means more options, less competition, and stable prices.
Local governments must reform zoning and speed up approvals.
The federal government can incentivize pro-housing policies and invest in construction innovation.
Builders need to focus on affordable entry-level homes, not just luxury properties.
Recovery depends on thousands of decisions in city halls and on job sites, not just the Fed. The 2025 rate cuts were a test. The market's response was clear.
The real work is about supply, not interest rates.
Fixing housing means long-term commitment, not quick fixes. The path forward is building, not just borrowing.